Well, when one company buys another company, there's typically one of two ways to do that. One is an asset purchase. The other one is an equity purchase. An asset purchase, the way that works is you agree upon a purchase price of the business, and then you allocate amongst that purchase price, what are you actually buying, whether it's furniture and fixtures, goodwill, what have you. So when a buyer comes in to buy an asset or assets from a business, that's all they're buying. They're just buying the assets and they're not buying the entire equity of that company. And then you allocate amongst the assets in that particular business. And that's what the buyer, preferably the buyer, likes an asset purchase better, because then you can depreciate and actually write off for tax purposes the allocation of the assets amongst the purchase price. So it generally works better for the buyer to have an asset agreement or an asset purchase for that reason. And also, they're not assuming the liabilities at that point either, because when you buy the equity, you're also assuming the liabilities. So typically an asset purchase works that way. Both buyer and seller agree on that. And the buyer then allocates the total purchase price among all the assets in an effort to get the most preferential tax treatment possible. When you sell a company, you generally have one of two ways to do that, either an asset sale or an equity sale. From a seller's perspective, now there's contrary positions on this, because a buyer typically wants an asset sale and the seller would prefer an equity sale. The reason for that is the seller generally would get capital gain treatment, which is a preferential tax rate, by selling the equity versus selling assets. Sometimes you'll have ordinary income component, which is a bit higher than capital gain treatment. So from a seller standpoint, selling the equity is better. However, from a buyer standpoint, buying the equity is not such a great thing in a small business world, because you're also assuming the liabilities, and then there's no write-off for the buyer. There is a little wrinkle though in the tax code. You can treat the equity purchase as an asset purchase under, for example, in an S Corp, you can make a 338H10 election where basically you're treating an equity transaction as an asset deal, where so sometimes if you mix that in, you can get the best of both worlds for both parties. So there's several factors that you need to think about when you're thinking about selling your company. First and foremost, getting your books and records in order so that it makes some sense, in that when the buyer comes to do their due diligence, there's nothing wacky, there's nothing sort of goofy in there that doesn't look right, and your trends look good, meaning you have a good record of books and records for the last short period of time, preferably at least 5 years of good data where there's some measurable results. If the books are messy, generally, that's the equivalent of if I'm a buyer buying a car, I'm looking under the hood and it's a total mess in there. The car may run great, but if it's a mess and it doesn't look so hot, generally that can put a damper on the purchase price as due diligence is performed. The other thing leading up to a sale is you want your tax records in order too. Many sellers are focused to the extreme on, driving down tax profits, and, rightfully so. But when a buyer comes in to buy that, they're going to be looking at the tax returns and also the financial statements. So if the tax returns show relatively low profits, that's something that has to be explained by the seller. And generally that doesn't go over well if the seller is just simply saying, well, I do it for tax purposes. That's not a great answer. So in general, leading up to a sale, you want to have your books and records in good quality order for at least 5 years, and also your tax records, hopefully showing a profit over the same period of time. So an installment sale, by definition, is when, let's say you sell your company and there is a payment there's one payment, but then there's another payment that goes into the next year, or even more than that. But there are payments over multiple years. That's considered an installment sale. And that basically means that you recognize the gain from the sale of that over a period of time. And a portion of that gain is going to be basically your return of basis. It's going to be capital gain, and it's going to be interest income, usually in those particular cases. There is a little wrinkle. You can actually elect out of installment sale treatment should you wish to do that, which basically means you're accelerating the gain all into the first year. Now you may say, well, why would I ever want to do that? Well, there's cases where you want to do it in which that If you have losses, say from company number 2 that you're also a part of, and that's coming into this year, but you're not going to have that next year, you may want to use those losses to offset the gain. And that way your subsequent year's payments on the installment sale do not become additionally taxable, because I'm using the offset of the loss from company B to consume the entire sale income in company A. So you can actually elect out of installment sale treatment to do that. So a couple wrinkles there you can play with as you make a consideration on whether to actually elect out of installment sale or continue with the installment sale treatment.